Welcome back, traders and investors. Special guest on today, Doug Kass. He is the president of Seabreeze Partners Management. Doug, how you doing today?
Good morning, Joe. How are you? Thanks for
Doing.
having me on again.
Oh, well, you're welcome. Love to have you on. First, let's talk about Apple a little bit here. A little bit of disappointment at the conference yesterday. A lot of things going on with the split. Nice volatility the last couple days. Give us your short and long-term outlook on Apple.
Well, just as a means of historical perspective, back in late September when the shares were $700, I wrote a piece on the street in Real Money Pro called The Bearish Case for Apple, in which I said the competitive landscape was changing. Apple's profit margins were vulnerable, and earnings estimates by the consensus Wall Street sell side was too elevated. And it obviously turned out to be the case. The stock traded all the way below 400, subsequently actually bought a little stock, traded it 5 or 6 times in the interim. Recently, after a better than expected first quarter, the shares have rallied from around 510 to 6, as high as 646, and had a major reversal on Friday, which I think was a significant technical warning sign and the sign of an intermediate top. I think a lot of Momo guys got involved in the shares after the quarter, bringing it up around 70 or 80 points higher than where the stock gap opened after the quarterly announcement. And then, of course, the company announced the acquisition of Beats, which is really, to me, a non-event. It doesn't move the needle. It's probably going to be a slight disappointment or a slight pleasant surprise. The media has a tendency to become hyperbolic about these things and make these profound statements about its import, and it's really not important as measured against the size of the company's sales, EBITDA, profits, etc. So I think the stock is fully priced and probably in line with my market view, which is cautious, vulnerable over the short term.
Okay, all right. I share that outlook as well, and I had that same outlook at 600 though. So I like to see right before that split, right when it starts trading, that first day on June 9th. I think that'll be important to keep an eye on those levels, but no doubt has had one heck of a run.
I do think that Friday, Joe, was a significant day technically for the stock when it was up 9 and closed down 3 or 4, and it's been drifting since then.
Yeah, and it looks like a lot of air in this thing under yesterday's low.
Look, my basic case back in September of 2012 remains intact.
Okay.
The company's earnings will basically be in a range of $35 to $50 as far as the eyes can see. It's a mature company with a very strong foundation and balance sheet, obviously great market share, but its market position is exposed to new competitors, and it's simply, it's a law of large numbers. The company's gotten so large, it's hard for any new product to move the needle.
Yeah, I agree with you on that. Let's just talk about the financials a little bit. I know that was part of some of your bearish positions,
Sure.
And they really haven't gone anywhere. The markets went up.
No, my basic thesis, Joe, was that rates were going to be low for most of the rest of the year. Net interest margins and net interest income spreads would be challenged. That the benefit from credit quality improvement over the last 4 or 5 years is basically over, and loan demand is tepid, consistent with my view that economic growth domestically will miss expectations. So I think earnings estimates, too, in the banking industry are too high. The stock's had a big run over the last 2 years, and they're beginning to show signs of consolidation, and I think that continues. They move at best sideways, probably lower. I'm sure Bank of America and J.P. Morgan.
Okay. Like I'm looking at the Goldman Sachs that had some decent earnings and just can't seem to break out of that range. And some of these
Goldman Sachs is more of a capital markets play and investment management play than ever before because of Graham Dodd and the capital ratio mandated capital ratio drops from Graham Dodd. So, the company's returns on invested capital and its terminal price earnings multiple should be substantially lower than it has been in the past, and that's what you're seeing. You're seeing meager ROI for the company, and both Goldman Sachs and J.P. Morgan, and I believe Bank of America as well, relating to the Merrill Lynch division, said capital markets activity in the second quarter was very, very slow.
Okay, so going to just the overall market here, some of the momos have come back, and you've had many stocks from different sectors making new all-time highs here. So, Bull's still in charge. What derails this market?
Yeah. Well, there are times when the market gives the impression that it's fading into nothingness, that volume becomes very low, trading ranges become relatively small, volatility becomes modest. Also, there is very little change in the market levels, and day-to-day fluctuations are minimal, especially compared to prior experience. Looking back in history, when this happens, it's almost always a sign of a market top. I'm actually at my highest net short exposure for the year, so that speaks volumes about how I see things. And I recognize that low volume, complacency, and even technical divergences are not really reliable timing tools. Nevertheless, the rise to new highs is potentially troubling when these issues are factored in with some continuing fundamental concerns I have, and which I spoke to you about a month ago. For instance, disappointing global economic and corporate profit and profit margin growth, corporate and consumer dependency on low interest rates, the failure of quantitative easing to generate really escape velocity in the economy. The result is kind of a detachment and a blurring in the demarcation line between progress and fantasy. So I think we have to be vigilant here and aware that the stock market's risk-reward ratio has eroded with every passing rise in the S&P 500. Most investors and traders, to me, who obviously would share my concerns, should be considering taking money off the table, having below-average exposure to U.S. stocks now, and continue to do so in any further ramp in stock prices. I thought for a while that, beginning about a month ago, that the market would take out new highs and that there would be this final top on low volume, and I think that's what we have experienced and maybe are experiencing right now. It's always impossible to predict a decline, but it seems to me, to paraphrase a famous politician, one of the only things that we need to fear today is the lack of fear itself.
Yeah, we've heard that one before. There's been some merger and acquisition activity in the food sector. Some of these biotechs are getting bought out, but yet some of the small caps are down quite a bit. What's your take on the biotech sector? There's still opportunities?
I think, getting back to your last point on the small cap stocks, I think, in the past the Russell has been a forerunner of market movement. And the Russell, the IWM ETF, has performed poorly both relatively and absolutely, as you're well aware of. In terms of the merger and acquisition activity, as well as the unprecedented buyback issue, these are all conditions that typically occur closer to market tops than, obviously, market bottoms. And to me, it's a sign of, corporations historically buy high and sell low. And this is another example of it. Unfortunately, what we've learned from history is that we haven't learned from history.
That's correct. Looking at the gold market, Bernanke hitting in a CNBC article that, might having inflation break the 2% level. Gold, I kind of was trying to pick a bottom at the 1290 level. That didn't work. Now you're getting a triple bottom here at the 1240 level. What's your outlook for gold, short term and long term?
Joe, I always like to say that when I don't know a lot about many things, but when I think I have an idea and I've analyzed it well, I offer my opinion, and it's only my opinion.
Okay.
And I prefer when someone asks me a question if it's something out of my body of knowledge.
Okay.
I tend to say I have no idea, which too few people on Wall Street say I don't know. I would say one thing. To me, just generically speaking, gold is like religion. In religion, you either believe in God or you don't. In gold, you either believe in gold or you don't. and it's very much religion-like, a religion-like asset class. Um, the momentum, obviously, 3 years ago, it peaked at $1,800, $1,900 an ounce. We're down to $1,240 an ounce, and the same people like the 1,800 and 1,900 like it at 1,240.
Okay. All right. Any new picks on the radar for you? I know you. I mean, I know you have your short exposure, but I know you like to buy things too. What do you
Yeah,
got?
on the long side, I actually just wrote a piece this morning on Real Money Pro in the Street regarding Radian Group, which is one RDN is a symbol. It's one of the largest mortgage insurers extant, and the company, because of what's going on with home prices, in their 2011 to 2013 vintage period of business written during that period, is experiencing really its best delinquency and profit profile in history. We have a pause in housing, which I predicted about a year and a half ago, after being very bullish and outside of consensus on housing. And I think what this pause is doing is it's serving to elongate the housing cycle. So we have a lot of pent-up demand, which will come to the fore probably maybe late 2015, late next year. And it's going to elongate the domestic housing cycle, which is really great for Radian and other mortgage insurers.
Okay, and last time you were on, you gave us a look at BONT, and I believe that stock was trading a little bit higher now. You still sticking with your bullish thesis on BONT?
I am. The company, as expected, reported since we had our last interview, modestly disappointing earnings, which were expected because this company is positioned essentially in the Great Plains and weather-influenced. First quarter results dramatically for this company vis-a-vis its competition, which is diversified and all around the country. But they did maintain earnings guidance for the year, which is very positive. Obviously, weather in May and June has improved, particularly in the northern part of the country, and I think their results will follow suit.
Okay. I just wanted to get your comments on yesterday's situation with Phil Mickelson and Jack Nicholson and the big gambler Billy Walters out there in Las Vegas and possible insider trading. Just wanted to get your take on that.
Yeah, I actually had an appearance on Fast Money Halftime yesterday on CNBC, in which I discussed this. I think in this country, you're not guilty until you're proven so. So let's start with that. But the optics are terrible. Billy Walters is friendly with Mickelson. Mickelson doesn't know Icahn, but Billy Walters is very friendly with Carl Icahn, and I believe they had some business dealings in Vegas together after Carl Icahn bought control of the Stratosphere Casino. I actually had highlighted the Clorox options activity to the Nigerian boys on Fast Money back on July 11th, 2011. And then obviously 4 days later, ostensibly Mickelson and Walters bought options during that period, and 4 days later, Carl Icahn delivered a $76.50 takeover bid for Clorox. So as I said, the optics look bad, and it's just going to have to play itself out. Since none of us have the facts, it's hard to opine and make a judgment
Right. Okay.
as to the legality of the actions. We do know, however, that there is precedent. We're dealing with two guys that are inveterate gamblers. Billy Walters is probably the biggest gambler in the United States. And Phil Mickelson never denied the charges that back in 2004, he switched clubs from Titleist when he was having the best period of his golf career to Callaway for an $80 million contract. And the rumor was that he needed to do that deal to cover substantial gambling debts. So, we understand the kind of personalities we're dealing with.
Okay. Final advice for traders and investors today, and we'll let you go.
My advice is to spend more time in your garden of vegetables and plants than your stock market garden during the summer. I think it's going to be, at best, a sideways market, at worst, a more significant correction than many of the pundits are expecting. There's a great deal of complacency, and we all know that an extreme lack of fear and complacency often begets market instability. So be vigilant, keep your positions, be diversified across company and industry lines, keep your average positions lower than normal, keep your cash reserves higher than normal, and enjoy the summer.
Okay, words of caution from Doug Kass, president of Seabreeze Partners Management. Doug, thanks a lot for coming on. We appreciate it.
Jojo, thanks. It's a pleasure always being with you guys.
Okay, thank you.